So I think it's pretty interesting when we look at how the markets progressed here. Nasdaq decent had a decent slide in the last couple of days. Obviously underperforming S&P 500, right? And bonds have just there's no love for bonds in over the last month. It's pretty aggressive to the downside. Hopefully we see some type of reversal, but other than that, like both are now under pressure. Equities look like they were going to break out, but now they're they're down. And I think two things are driving this. Number one, the election's early next week, so maybe there's like a risk like shift where everything kind of flips more risk off into the election, then relieves afterwards. It's a possibility. The other thing is bond yields I think are up a lot for this current situation or the current economic environment, I should say.
Yeah. What
These are
what
the
is
bond
the
ranges.
what is
These
the justification for bonds being up? For bond yields
well,
being up?
you mean bond yields? Yeah. So I think there's a lot of factors that have pushed up yields. Number one, I think the immediate slowdown in the last NFP print at the beginning, like when we got the unemployment rate ticking down, it was just more fuel that ignited a move in rates. Because if you look at the chart here, you have these two ranges, the bad for stocks and bonds and bad for stocks only. And what you'll realize is like mid-September before the last NFP print. And by the way, we get one tomorrow, right? So, but before the last NFP print, we actually start breaking the range and rates were down pretty aggressively. And I think the market was getting kind of baked or hyped up on the idea that the unemployment rate was going to just really the degradation was going to really accelerate, right? And it was going to just get worse. And what ended up happening was the complete opposite. And then the market kind of had to unwind in a very linear pattern. And that's what we've seen here. And if you notice looking at this chart, things have gotten pretty shaky for both stocks and bonds since we took out the 4.3 mark to the upside. So I dropped these ranges like a month ago, maybe a little over a month ago, on X, just alluding to the fact that anything above 4.3, anything below 4 is, one is bad for both, one is only bad for stocks. And sure enough, stocks have not been able to progress, especially the NASDAQ, with us being above the 4.3% mark here. That's bad for stocks and bonds. It's possible we
It's
could
more
see
so just
stocks
like
turn around.
the interest rate sensitive stocks that it's bad for. Because the S&P's been moving. It's really the Nasdaq, the Russell that we've been seeing struggling.
I mean, even Bitcoin's moving, right? So Bitcoin's up too, and we'll talk about that in a second. So obviously, it's not everything, but we like to focus on the Nasdaq. It's not what we benchmark against, but it's what we trade because in a real risk-on environment, Nasdaq should be running laps around the S&P. So that's why we like to focus on the Nasdaq. But all in all, Nasdaq's falling apart a little bit. This could be election related. Maybe it clears up next week and stocks continue to grind up again. But what you'll notice is when rates aren't in a downtrend like this, given the current macro environment, it's harder for equities to go up. Like you'll notice here, like look back in end of 23, when rates fall like they did, Nasdaq rips, rates come up. The pace of ascent slows, and that's pretty much what we've seen here as rates ripped off the lows. The rise has slowed, or the ability for the Nasdaq to move up has slowed. Rate sensitive, whatever it may be, and bonds have gotten smoked in the process. We'll have to see how this progresses here. We have jobs report tomorrow, election early next week, FOMC later next week. So it's a jam-packed like 7 days that we're going into. So with rates up the way they are over the last like 30 days, I think there's a decent probability they go down from here. We're going to have to see what the NFP report does tomorrow. We're going to have to see what the election looks like. I mean, the market's pretty much priced for a Trump victory at the moment. So we'll see if it's a buy the rumors, sell the news type of thing, where if he wins, the market kind of corrects itself, or if it's just going to continue to price in that a projected path based on the policies he's been implying in his speeches. And we don't really know, right? We're gonna have to see how that plays out. The one thing that we've made very clear is, we're in a risk off regime. As crazy as that might sound, and doesn't mean risk on assets can't go up. It just means we're more prone to risk off activity. So in risk off things tend to happen. So Um, Obviously, the bond move has been something that I think, in my opinion, is really election related. Because if we were to overlay gold onto this chart, just throw gold on here, right? I know we're getting kind of a bit messy, so let's take the Nasdaq off. What you'll notice is gold has not stopped. Like when bonds peaked, gold has just gone vertical since, right? And bonds have gone down. I think that's an election effect because, a lot of people are really, like we said last week, are just jacked up on this Trump fiscal path that they believe is going to really destroy the number one, the credit worthiness of the country, and just blow out the deficit, right? So bonds, therefore, are in turn more risky in terms of like you're taking on additional risk, and when you're the risk-free benchmark for the world, even if your default odds go from 1 to 3%, it's very significant, right? So, and that's something that I think bonds are trying to deal with right now.
Yeah.
But
And it's kind of like
what do
a
you think with this
gold is
whole
kind of
gold
like a
thing?
flight to safety that people have been doing because where else do you put your money? Like the Nasdaq's kind of struggling and the outlook for stocks is not the best. Outlook for bonds is also wishy-washy. You really got gold and Bitcoin to put money into, and those are what have been ripping.
Yeah. We do have a Bitcoin allocation currently going, which is pretty good. I mean, it's helped add something to the NAV over the last couple of weeks where we've been dealing with this bond nightmare. But um I think that Bitcoin is in a situation right now where most people look at Bitcoin and they'll say, okay, it's going up, so we have to be in risk on. Now, that's not necessarily the case. You have to really understand how Bitcoin works. Um, if Bitcoin is not in a bearish trend, there tends to be tailwinds in its sales, right? So like it has the ability to just go up, as stupid as that sounds. But it's when you get into a real risk on regime where you get the God candles of like 5 to 7% days back to back, like this type of move. Like this move is a risk on move. But like this type of move can happen in risk off, insinuating that maybe there's a risk on event coming. But there's a lot of other factors here that are just very cloudy at the moment, right? Like number one, the election coming up. Trump's seen as a pro crypto president. So that alone could be moving the crypto market, right? It's very hard to decipher given what's taking place over the next week here, what is showing what. But yeah, we do have a Bitcoin long on at the moment. That is where we are with Bitcoin.
Yeah, what it's telling me is we're either on a path to a risk on environment, or we are just kind of in a very shallow risk off environment that could reverse and go back lower, as we saw when bonds were ripping and we saw the whole risk off environment. We saw stocks sell off, and that was a fairly relatively deep risk off regime where bonds accelerate in that environment. And so now we're kind of in a shallow risk off environment, possibly heading to risk on. We're kind of in like that middle ground, which makes it a lot trickier to decide where to park your money.
Right. And I think that's a good point to really emphasize on that shallow risk off, because we've said this quite a bit over the last, I'm pretty much the entire time we've been doing these podcasts, that just because we're in risk off doesn't mean stocks can't go up. And I think we've been doing research on this over the last couple of weeks. I've been doing a lot of R&D actually. And we're researching the idea of basically isolating our regime forecast. So for those that know, we have the risk on, which is expansion, inflation, and then deflation, stagflation on the bottom, risk on, risk off. But not always is that such a cookie cutter case, because what ends up happening is if you are to fall, let's just say a couple of points into risk off, it's not deep enough to what would be considered a recession or a crisis. It's more of a slowdown. And slowdowns don't necessarily mean risk on assets can't do well. And we're thinking about implementing, we're still doing research on this, so I don't want to talk too soon, but we're thinking about implementing a cushion in the risk off zone that it would be, we'd call it a slowdown zone. So it's something, think about it like a barrier before you get to the real risk off, the real like danger mode or danger zone. And in that cushion period, there could be a mix of risk on assets that could be held in a portfolio to amplify those slowdown style returns, where when you're in a slowdown, like the stock market's going up, but it's kind of choppy. Maybe there's some equity sectors that are really outperforming the market, but it's very isolated. And in those environments, you can leverage up those ideas, capture some alpha. And if you kind of fall beyond, or if you do fall beyond that that slowdown zone into risk off, you have to really pivot aggressively and instantly to those traditional risk off plays. And I think that's, something we've been seeing. Like if you look at something like utilities, right? Just an example, like utilities, gold, healthcare, a lot of these sectors are up net versus bonds. And we've always said this from the beginning, we're in a slowdown. And I think that this is one of the more controversial slowdowns of the last like couple of years, the last 5-6 years, where the economy is slowing down and you don't have the real effects of a recession. 2022, something like that, but you really had GDP getting whacked, right? It could have been a very like obscure drag based on exports or imports or whatever that may be. But at the end of the day, GDP was going down. Now we have GDP printing 3%, but we're seeing it like slowly tick lower. It's not bearish, but it's also rate of change looks like it's rolling over a little bit. Could that be proven wrong? Absolutely. And I think regardless, in that phase of a slowdown, you have to have a dynamic trigger in your portfolio that kicks in. So you're in the slowdown phase. It's okay for bonds, okay for equities, but it's really good for, let's say, the defensives, right? How can you leverage up the defensives in a slowdown and then pivot to the recession plays in an actual recession? And I think that's the key takeaway from all this R&D we've been doing. I know we haven't been as active on X, and it's because, we're only two people, Artie and I, right? So we're just grinding out R&D, and like there's only so much resources we can allocate. So once the R&D is done, we're going to be back banging on X. And I do think that we're seeing promising signs right now of a portfolio composition that adds a second variable. So it's not just long TQQQ or TMF. There's going to be a third component in there. And that third component is for the slowdown territories, which allows us to basically split the regime, the black and white into a gray zone. So it's not just risk on, risk off. It's like semi risk off. And that's where I think we can add a lot of value to the Aries returns in RQF.
Yeah, and it's sticking to those like defensive plays like you mentioned during those risk off periods is also very important. You can't just be like, okay, it's a slowdown, so I'm just going to hold the NASDAQ as well as bonds, because when you are in a risk off period, risk off things tend to happen, and those are very hard to time. And having these defensive stocks, you're able to kind of capture that risk on aspect. For example, like an expansion regime where you have decelerating inflation, but you still have positive growth. You're able to capture that. And if you do get some sort of risk off event that comes out of nowhere, maybe the system didn't quite catch it, those defensive stocks aren't going to drop nearly as much as any risk on assets like the NASDAQ, anything in tech, those kind of assets. So it still provides some sort of security while taking advantage of the upside potential there where bonds might be lacking, because it's not that full-blown deflation that bonds really need to accelerate. So that's something we've been looking into, and I'm pretty excited about it. We've seen some pretty good results from what we've found in our research the past couple of weeks.
Yeah, I just want to emphasize the CAGR only goes up, guys. There's no subpar updates. We don't downgrade, okay? So if there's a portfolio model update, it's with better returns. That's how this works.
Yeah.
Otherwise, there's no update at all. So like, we don't come in with a new model that's going to be worse than the old one. So
Yeah. And
even,
don't worry, we're not
we don't.
financial advisors, so it's never going to be a model where we just lower volatility but sacrifice CAGR. Like that's we don't give a shit about volatility as long as we have like a 50% CAGR. That's what matters.
Yeah, and I guess the key takeaway to like the portfolio stuff, right, is a lot of people will think like, oh, how do you adjust your portfolio? Like, what are you looking for? Like, are you looking for certain areas to be avoided? Like, oh, did you catch this event? Did you catch that? Like, I don't really care about catching. Like, for example, some of the back tests we're running right now do show like us still taking the bond drawdown. We would just because we're in a bond drawdown, we've eaten the bond drawdown, doesn't necessarily mean like the model's broken, right? Because you can't fit the model based off of what's happened. So like, you know, we could look at anything like in the Nasdaq back in April, right? We ate a drawdown here with this whole when the whole all those Israel headlines broke, and then we were fine afterwards, right? You can't fit your model for a drawdown because what ends up happening is you overcomplicate the model and then you end up actually breaking the model because you've basically built something on weak foundation. So for us, we don't really care so much about avoiding specific drawdowns. We care about doing our best to minimize the average drawdown while maximizing the CAGR. Okay, like the max drawdown is going to be the max drawdown. It is what it is, right? So our goal is to minimize the average drawdown because in reality, the max drawdown might have been a sequence of drawdowns. Like, you know, for example, you go risk on, you take a drawdown, you flip to risk off. That you take a drawdown there, and then that flips back to risk on, and you rip from there, right? So you have an extended drawdown, which might be an odd scenario. The real key is the average drawdown because that's where like you're going to experience most of the pain in the model. And that's where we optimize the model for, like, or what we optimize the model for. We're not going to, you know, we're not going to design the perfect model to have the lowest max drawdown. And what happens then is you have no returns. You end up with a model that underperforms the S&P 500. So that's the main objective. And we've been spending a lot of time in R&D going over I guess you guys know listening to this, like how our approach has been. It's always been the simplest model with the best returns. Like we can develop a really complex model, and we have complex models, but we can like publish these models where that, you know, you're trading 20 different assets, you know, you're doing 3 to 4 trades a day. And in reality, it's just going to confuse more people than it will help. And it's a pain in the ass to keep up with. And the idea here is to reduce your screen time, maximize your returns, and just compound in the background, right? You should be able to live your life, work a job, go out, have fun. Like that's the objective of these models, like in theory, right? How they're implemented is a different story. They're hypothetical. But the idea is that you can use what we give you to maybe build your own model or, you know, format your or guide your own process and put yourself in a position where you're not glued to a computer screen 6 hours a day watching the NQ tick by tick because you're about to get blown out on leverage. Like that's not what you're supposed to be doing, you know? We hope to be back pumping in action on X very soon. And when we do, we will have some new content for our members and for our followers. Until then, thank you guys so much for listening. New weekly podcast again next week. We'll cover the Fed. We'll cover all the events, the election, and of course, the jobs report, which comes out tomorrow. Thanks again for listening. We'll catch you on the next one.